Happy Tuesday on 1342. It's your skipper here at Darius to present our macro minute for Tuesday, November 12th, 2024. As always, we'll start with the executive summary from today's lead-off morning note. If you would like to review the analysis supporting these conclusions, as well as what specific changes you need to make in your portfolio to remain on the right side of market risk, you need to be a client of 42 Macro. So today's key macro question is, do the latest key economic data support recent global macro flows? Our answers are, there were a bevy of economic data points released in the past 24 hours that, on balance, support macro markets' recent pricing in of the likely Republican sweep. On balance, the data are generally supportive of a widening policy divergence between the Fed and ECB, as well as the Fed and Bank of England, the both of which are supportive of a stronger dollar. Dollar strength has roiled precious metals of late, with gold and silver down 5% and 6% week over week, respectively. Physical commodities have taken it on the chin too, with Brent crude oil and copper down 4% and 7% respectively week over week. We believe investors should buy the dips in gold and copper as monetary debasement, financial repression, and physical consumption of industrial commodities within the U.S. economy are all likely to accelerate dramatically in the coming years. The supply picture for crude oil is too challenging to make a call on at the current juncture, given that OPEC Plus can increase supply substantially at any moment if the trailing market share losses become an issue. Moreover, silver is simply not as good as a monetary debasement hedge as gold or Bitcoin. Transitioning to our 42 macro dashboard here, as always, we'll wrap up with a question from our community. This one's regarding gold allocation. It says, hi, Skipper, hope you are well. With regards to the gold allocation, I'm trying to understand the rationale a bit better from a multi-factor perspective. As nominal yields trend higher with wider term premium being priced in, will this not somewhat offset the widening fiscal deficit as a driver of price? I assume the positive liquidity impulse from a potential TGA spin down and amid the upcoming debt ceiling saga might also be a positive price catalyst. Sincerely appreciate your take on this, and I sincerely appreciate you, my friend. So first thing I'll say is that the wider fiscal deficits aren't our bull case for gold. Our bull case for gold is how the Federal Reserve is likely to be forced to respond to wider fiscal deficits as a function of volatility in the U.S. Treasury market. And I believe we are seeing a lot of that. You know, we've had term premium on the 10-year specifically back up about 30, 35 basis points since mid-October, you know, as the markets, you know, increasingly priced in what the Republican sweep scenario meant for the outlook for U.S. debts and deficits, which, I mean, I've been doing this for 15 plus years now. It's crazy to say out loud that the Republican sweep scenario equals way more debt and way more deficits. But as we've shown in our hard-hitting investing doing a fork-turning analysis work, the Republican Party, since the post-war U.S. economy, since the advent of the post-war U.S. economy, the Republican Party has been the party of debt unequivocally, with 7 of the top 9 presidential administrations that have been responsible for 7 of the top 9 growths in U.S. public sector debt have all been Republican administrations. So this is part and parcel to how things have historically played out. It's just very counter to, you know, the prevailing, which I would consider to be very lazy, poorly researched narratives amongst investor consensus, you know, organizations like Fox News, et cetera, but that is what it is. When we're talking about, you know, public sector, going back to gold, obviously if we had, you know, more liquidity vis-a-vis TGA spin down, the likely TGA spin down, we're north of $800 billion currently. And if we're correct on our view that we're going to have a debt ceiling impasse at the beginning of next year as a function of the, you know, sort of as a function of the Senate not, you know, being 60, you know, the Republicans not capturing 60 seats in the Senate, then we are very likely to see about $800 billion of spin down in the TGA between now and, you know, early April. It usually takes about 3.5 months for TGA to go from $700 billion to zero based on historical debt ceiling episodes, looking at 2021 and 2023 respectively. So that's positive for gold. It's likely to be negative for the U.S. dollar. We could see a decline in bond yields because, again, you're talking about a treasury that will have reduced borrowing authority or no borrowing authority rather in the first part of next year. So you're going to have no incremental bond supply. You have no incremental. You will have incremental bill rolling over, but you won't have any incremental coupon supply. So that's obviously supportive as well. So that's our medium-term view on gold. But again, our longer-term view on gold is a belief that, based on our analysis of hundreds of years of data, you know, in terms of how the economy and fiscal monetary policy and geopolitical dynamics have evolved in historical fork turnings, you typically see way more financial depression and monetary debasement than you typically observe in non-fork turning scenarios. And so it's our view that we're going to continue to see an explosive growth in U.S. public sector debts. And as a function of that explosive growth in U.S. public sector debts, the Federal Reserve, being the only institution in the world with a balance sheet large enough to keep pace with that, will be called upon to increasingly keep pace with that, and ultimately that should cause significant monetary debasement and ultimately significant acceleration in the prices of gold and other risk assets like Bitcoin, real estate, physical commodities as well. But again, it's not going to be a linear ride up. We talked about this many times. There will be refinancing air pockets when the Fed needs to get its head from buried in the sand, and from out of the sand to actually do something about the explosive growth in public sector debt. And right now we're in this sort of pocket witness window where the Fed isn't doing enough. And so that's why you're seeing a decline in the gold price. But eventually the Fed will be forced to do more, just like they were last summer, just like they were in March of 2020, just like they were in January of 2019, just like they were in December of 2015, just like they were in the second half of 2011, just like they were starting in the first quarter of 2009. Again, this is a Federal Reserve that's going to be cajoled by market responses to do more financial repression and monetary debasement at accelerating rates over the long term. That's our core fundamental belief and how we're approaching risk asset markets with a generally structurally bullish bias on risk assets, real estate, crude oil, copper, not crude oil, commodity, physical commodities, crypto, obviously stocks and credit, and a structurally negative bias on treasuries. Doesn't mean treasuries are going to go down in price or treasuries, won't return what they're supposed to return on a nominal basis, but ultimately it does mean that those treasury bonds, those securities, of which there are a great many of them and will be accelerating great many of them, are unlikely to keep pace with those types of returns on a real basis, and unlikely to keep pace with those types of returns on a relative basis either. So that's our fundamental view. It's based on hundreds of years of data analysis, our analysis of hundreds of years of data across dozens and dozens of time series in terms of how the asset markets have historically performed in forward-turning regimes. So if we're wrong on that, check back with me in a decade, and guess what? KISS and Dr. Mo would kept you on the right side of market risk regardless. And if you don't know what KISS and Dr. Mo are, you're probably having worse investment performance than people that do. So we'll wrap it up there. Darius still wrapping up our macro minute for Tuesday, November 12th, 2024. Everyone have a wonderful day out there. Best of luck. We'll catch you back here tomorrow. Cheers.